Hello, hello. Good morning, Morris. Hey, can you guys hear me? Is that okay? I'm at a different place, different setup, so just want to confirm. Everything looks good. For whatever reason, I can't hear you guys. Hold on, let me see if anything wrong at my place. Um, okay, so Morris says he can hear me. Um, can anyone do a sound check for me? I just want to make sure that I can hear you guys.
Morning.
All right, that works.
Easiest test to take.
Exactly. That's true. All right. Like I said, I'm traveling. I'm near doing my parental duty, getting my basically chaperone, not chaperoning. I've just dropped my kid to a university. She's here out here for a conference. So I'm near LA. Um, so we drove like yesterday after school, almost 7 hours drive, including a coffee break. Reached here. 10:30 p.m. ish, and then I
Uh, what
dropped
happened
them.
to the high-speed rail?
Huh?
What? Just joking.
Yeah, I'll wait for the high speed rail, then maybe I can cover LA in 2 hours. But so we were debating between in terms of flying versus driving. Flying itself, getting into LAX and then driving from, getting through the LA traffic would have been bad. So we decided, why let's better is to drive down and we'll basically head back today evening. We'll head back home. So I'm just here for her conference. So yeah, I'm sitting in the hotel, and we thought, okay, let's have fun. Which is under construction when funds are available. I think that whole high-speed transit has been under construction for decades now. I don't know when that'll get done. Anyway, so what else? Oh, how are you guys doing in the market? How was this week? Everything okay? Any concerns? I hope not. Markets are doing. Morris is terrible. Come on, you're not happy with what happened on Friday? It maybe you're watching too much of CNBC or Twitter Spaces. Because as I see it, I mean, we are still up more than 10% for the year, so life is good. Or maybe we
The
are back
problem,
to.
the problem is when you buy high and all of a sudden something goes down. Yeah, do you sell? Do you keep? Do you sell? Do you keep? And that's the great conundrum. And investing's not easy.
Yeah, yeah. If investing was easy, everyone would have been rich. Right? And it's the hard part is not that where to invest. The hard part is going through these motions. So I think we were all happy if we were a 50K and we were up from 50K reaching 80K, we were all happy. And then from went to 100K back to 80K, we are all sad. It's still the 80K number is still the 80K, right? But going going up, it looks amazing. Look, getting back to the same number it's feel bad. I mean, so I look at what SPY, and I'm like, dude, it's still up double digits. What else? What else do we need? But yeah, we hear all the commentary around it. It looks like, oh my God, the markets have been terrible. Aditya, welcome to LA. Thank you, Aditya. Yeah, we were trying to. What I mean, I was trying to avoid getting into LA in and out. So I'm at a place near Channel Island. So that's where the conference is in Channel Island, CSU. Ramesh says it was bloody. I don't know. I think that the markets are just fine. Just fine. All right. So today, let me see. We got quorum. Anyone joining here for the first time? Any new joiners here? Maybe we can have a couple of introductions before we start with our regular agenda. So Tom, Harsh, Tom, would you like to introduce yourself? What brings you here? What kind of investor are you? And what are you looking to get out of, next, I would say 2 or 30 minutes?
So thanks for hosting this first off. Second, I've been trading since I was 17. As many years ago as I'm 66 now, retired a year ago, and I've been a full-time trader really since COVID hit,
Mhm.
and I've done pretty good. I'm more of a shorter term trader, uh, sometimes day trader, sometimes swing trader, sometimes a little longer if prices trend higher. But it's really more about profitability than it is time.
Mhm.
And I've been pretty successful most months, down a little bit this month, but marginally so. And I guess I'm pretty cautious at the moment. And last comment I'll leave you with is I hear a lot of longer term investors saying, well, the S&P is still up this for the year or whatnot, or I'm still ahead on my positions. But I find that personally is little consolation when you see stocks at substantially higher levels than we are now and foregoing all those potential profits uh, at current levels uh, merely because you're still up, you're still ahead of the game, or the current price is above a moving average of some sort, whether it be simple, exponential, or something
Mhm.
else. So down is bad, up is good. And for me, price really is all that matters.
True.
And I guess I would just end by saying I'm cautious on the market. And right now, something in the current trading session is making a lower low than the prior day. That's not a good signal to me. And
Mm.
I want less of that.
True.
So anyway, thanks for hosting.
Yeah, you're welcome. And thank you for joining. You've been investing way longer than I have been, and probably I think there are a very few number of folks in our group who have been investing as long as you have been. So we all can learn a lot from you. And especially, I think I'm looking to learn a lot because I'm not a swing trader or a day trader. I'm one of those who was like, okay, I want to do long term. I trade daily, but most of those will be my hedging trades. So welcome. Let me see. I think Harsh also mentioned he's here for the first time. Harsh, why don't you, if you would like to go ahead and maybe introduce yourself?
Yeah, hi. Thank you for hosting again. I actually started trading 4 years back. As I mean, when COVID hit,
Yeah.
and that was actually my first time when I started trading. And since then, I've been trying. I was introduced to options trading. I was introduced to a lot more things, but I continued with options trading. And initially, I was profitable, but then it went all down. So I started thinking, okay, should I try to understand more? And that's where I started talking to people, and they suggested to talk to a few people who are actually interested in this and discuss where you are going wrong and what could be the possible way forward. So yeah, I'm trying to figure out what's the best way for investing, I would say.
Cool. All
Yeah.
right.
Pretty
Well,
early than the earlier guy. Yeah, sorry, John. Yeah.
cool. Welcome. Yeah. Mm, uh, I've been doing both the options as well as the long stocks for now almost a decade. I love doing that. Use options mostly for buying the stocks lower than the market price, hedge my portfolio, and just stay invested in the market. That's and has worked for me in overall scheme of things. So I'm happy with it. There are many folks who have been trading options much longer than I have been. So you may want to ask those questions once we get into the breakout rooms. Because I know many folks, I mean, everyone has a different style of investing slash trading. So the way, I do these sessions is I'll start with general market, few analysis on some company or on any investing theme, etc. I'll do that for around 2 hours, and then we break out into different breakout rooms. And options and futures is generally a very popular breakout room. And then the next one, which is more popular, is trading slash swing trading. So we'll see. I think you can have a lot more discussion, deeper discussions in those. But if you have specific questions right now on options, etc., yeah, feel free to raise your hand. I'll invite you to ask the questions during the session. Okay.
Sure, thank you.
Cool. All right. Anyone else new? We'll have 4 minutes before we'll start, so we can have maybe a couple of more introductions. Sam says, "Do you see HSR being built?" No, I was driving down in the night, so I don't even know. Maybe while going back, I'll check. Jose is saying, "Protect your profits." So there's a saying which says, "Nobody gone broke taking profits." I used to subscribe to that philosophy, but then I also realized is nobody has made substantial money taking profits earlier. So the biggest regrets that I have are not the stocks in which I lost money. The biggest regrets I have are the stocks that I sold early to take profits, and those became multi-bagger later on. If I had just held on to those stocks, I think all my losers would have been taken care of. So I used to subscribe to protect the profits, but as long as the business is doing fine, I'm like, okay, you know what? I'll hold on. I'll hold on to it. But that's just me. When stocks can go, I can only lose 100% of what I've invested in, unless I'm leveraged and all that stuff. But the stock can go 1,000% up, 5,000% up. So I've flipped how I focus on. I've flipped my script on profit taking. Not that I don't take profits, but I'll do it if I need, the money for various purposes. But I don't take profits anymore just because, oh, maybe I think stock is gonna go down. I have no idea where the stock is gonna go. So, all right, let's get going. Looks like, let me see who else is there. Aditya, Albert, Alfred, Asif, B.A. Clark. I don't know, Harsh, a couple of iPhones, John, Jose, Katrina, Lee, Lilia, Matt, Melody. I guess no one else new. Ravi. All right, so Aditya, making a loss on my IBIT put spread. Losses will always be there. I mean, losses and gains are the part of investing. It's not a one-way street, right? You already know it. I have IBIT put. I got assigned, so I'm holding it.
Yeah, I think that I made a mistake. I probably should have just taken an assignment on the 21st November thing. I tried rolling it, and that didn't go very well. I think it just carried forward. I had a 52.61 basically. But yeah, it's basically rolled the same thing to December. So
if it is deep in, so you had a spread, not the
yes.
short put. Yeah, rolling spread is difficult. It's not an easy stuff to do, and you get a credit. That is why if you are doing a spread, make sure you're okay if it become a full loss. Either you're okay to take that loss because losses are limited anyway because of a spread, or you just take an assignment and deal with the stock. Rolling the spread, defending a spread is generally difficult. I mean, max you can do is maybe sell a call spread against your put spread. So,
Right. Well, I didn't get an assignment, so I just rolled the spread, which means it booked the loss for.
that's fine. It's a temp loss, but you rolled it for credit, right?
No, it actually rolled for a debit.
So that's okay. That's what I was saying. Managing a spread is very difficult. It's not easy to manage the spread. So,
Right.
it's depending on the wall and everything else. I have found that you can't always get a credit. So if it is a spread, I generally either take the loss close the spread at a full loss and maybe buy the stock. That's what
Right.
generally I'll do.
Right. But typically, like, so when, okay, so I understand the lesson's probably not
So
true.
hold on your question for the breakout room.
Sure. Thank
We'll
you.
probably dig deeper into the breakout room on this one. Yeah. All right, so let's get into today's session. Let me make sure I share the screen and then we get going from there. Okay. All right. Okay, you guys will have to confirm what are you seeing on my screen. Because I'm on a single screen, so hopefully
In the presentation. Yeah.
oh, you're seeing the document. Okay, cool. All right, that's what I want you to focus on. Okay. All right. So welcome everyone to our discussion number 301 for our Saturday investing meetup group. So today I want to, two topics I want to touch base upon. One, I don't think need any introduction. I mean the street and the media has been all over this. This is what we saw this week was, hey, is the AI trade over? I saw a lot of bears coming out of caves on why this is, this is not going to work, why it is fraud and all that stuff. So we look at a few things. It's especially the biggest, um, company in the world. They reported the results, and I think that's the only company that is carrying the stock market for this year. So Uncle Jensen, Papa Wang saved we thought that he saved the market, but then market had its own mind. So we'll talk about that. I also want to talk about private credit. And I know this has been topic that have been, postponed it multiple times. So eventually we'll get to private credit and a lot of stuff that I see on private credit, especially the fact that maybe it will be very soon that you will start to see the options of private credit in your 401ks. So we'll look into what's happening in this. Should you own it or not? What is private credit? How does it work? Why suddenly so much interest among the issuers of private credit to involve retail investors, so on and so forth. Okay. But as always, I'll start with the general, economy. What did we see in the markets this week? A couple of maybe news from some companies, and yeah, that's on an agenda. And unless you have anything else, but that's what I've been thinking. Cool. Let me make sure. How do I see the messages? Okay. All right. So as always, anything that we discuss here is only for your education and don't take it as an investment or financial advice. Okay. So I love to start with some thoughts before we get into the real content. So today I want to pick up which is called cash, right? Importance of cash. So here are a few thoughts. So I was listening to, I think, a YouTube video and then some of the few podcasts. So I added, collected some information from that in terms of what's the importance of cash, right? It's not the smartest investor who survives. Is the one who still has cash when panic hits, right? When the blood finally comes, they have no money left, just theories and regret. If you don't have a cash, all we have is a theories of how great the stocks perform, how great the investments are. Third, the market doesn't care whether you went to Harvard or substituted whatever other colleges, right? Harvard or Wharton, it just waits for you to run out of cash. If you're managing billions or if you're managing your own small fortune, there is only one rule that never fails. Don't run out of cash when the world goes insane. Right? Cash buys you time, and time buys you judgment. Think of cash the same way a pilot thinks of altitude while flying. You don't need it all the time, right? But when something goes wrong, you'll be damn glad that you have it. They thought that the cash was for cowards. Turns out, probably last few weeks have shown that it is for survivors. Because
Sorry,
you make
your
money,
screen's gone away.
you make money in crashes, you just don't know it that time. So few thoughts on cash. Thought I'll share. So some of you may be able to relate to this thing because you wish you had some cash sitting on the sidelines to take advantage of the drawdowns that we saw, whatever drawdowns you may want to call it, right? We are down 6-7% on QQQ. And now, depending on if some of your favorite stocks are down 20%, 30%, and if you wanted to load up on it, you wish you had more cash at this point of a time, right? But anyway, so I thought maybe we'll start our session today with discussing the importance of cash. I don't know, was it Ray Dalio or who told that cash is trash? I guess it was Ray Dalio, maybe in 2021 or 2020s when the markets were ripping higher, right? So turns out that Bridgewater hasn't done that great for the last few years, right? Maybe he should have had more cash. Anyway, so if you have had cash on the sidelines, this week was maybe a good week to add to stocks that you were bullish on, and you think that have corrected more than they should have, right? That the market panicked. Now I can't tell you which stocks are great or not. It depends on how you understand the business, or if you are on the technical trader. Then your philosophy around holding cash could be very different than what I have. Right. Tom says, post a current cash percentage. Yeah, I share my percentage at the end of every month in terms of what I hold. The top 15 holdings in my portfolio, but I think currently I may be around 4%, 5%, 5%, 6%, around that. I don't generally like to sit at, let's say, 90% like you are. Buffett has been holding big cash for some years now. Yeah, but remember, he has a very different reasons. Because for him to deploy cash to make a meaningful a movement on, a meaningful change or impact to the overall portfolio, it's not easy. They will, number two, also let's understand that Berkshire run an insurance company, so they have to hold a lot of a cash in case of the payout. So Buffett being little more conservative, they do want to hold a lot of a cash as a reserve. Number three is Buffett is retired. He wants to make sure that he passes on the baton to Greg Abel with a lot of a cash on the balance sheet so that Greg can then take a decisions, right? So, and number four, he's not able to find any bargains, guys. And given the type of investor that Buffett and the Berkshire has been, yeah, the markets are not cheap. The markets are expensive. Right? They are not reasonable. Markets are expensive, and he doesn't want to invest in expensive market. So I think so. Berkshire, yes, their cash holding has been the highest ever, I think almost 1/3 of its market cap is just cash. Right? But it's different. We have to think what we have to do for our portfolio, right? So whatever, if you figured out what percent of the cash works for you, my whole idea is, hey, I just want to make sure I have enough cash available to survive any downturn, right? Upside will be taken care of. Markets generally have upside tailwind anyway. So as long as I'm staying in the market, I think it'll be fine. When I was saying I've held gold in lieu of cash, a certain percentage. Yeah, gold has done great over the last 2 years. I mean, it's done much better than S&P 500. Vinay, you will be a happy investor if you held gold, right? I have a gold, which is a small portion of my portfolio. I sold some last year, right? How did I know that is going to go another, whatever, 20, 30% this year? But I still hold some gold. Ruturaj, which 4 5 are the best stocks to invest in this dip? I don't know. I mean, it could be a best stock for me, may not be for you. That's a challenge when investing, is that it's like a medicine, right? Hey, it's great for me, may not be good for you, right? It's a precision medicine. You have to find out which stock is you can hold, you understand it, and then you can hold it to become the owner of the business as business continues to do great things. So some great business will be volatile. So I can tell, some numbers which I would like to hold, but then those stocks have many times have gone down 40%, 30%, right? And if your makeup is not like mine, that I can go through the drawdown. You may not be able to go through that drawdown, and probably will sell the stocks, and say, oh, come on, Vivek, you didn't tell me the good stock is down 20%, 30%, right? And I know these stocks will be down 20, 30%, but I'm okay with it. So you have to find out, Rituraj, in terms of what kind of investor you are. Then you have to qualify that I'm looking for stocks which are like these, which are reasonably priced, which are not volatile, or which are in these sectors that I understand, right? Otherwise, I don't think anyone can tell you which are the 4 or 5 best stocks to bet. So what did we see this week? We saw that volatility is back in the markets after 6 months of calm. We had 6 positive months: May, June, July, August, September, October. There's a big draw, not a big draw on what? We are down 6, 7%. Right? So all these last 6 months were driven by a lot of excitement around AI. And majority of the gains came from the top 10 companies. That's why it's become more, S&P 500 has become more and more concentrated, because it has maybe I think the top 10 now constitute 40%, maybe a little less this week, but the gains are coming mostly from the large caps. Now, we saw some cracks in those theory around the overall AI theme. Last week we talked about it. Michael Burry bought puts on Palantir and Nvidia, and then CNBC, Bloomberg, they were all talking about Michael Burry. It's a different game that he had basically shut down his fund now. Now he won't have to report anything to SECs anymore. But we did see some crack in the theory, in the stock prices, because I think the investors were a little concerned about high valuations and whether is there any ROI in this AI spending? Is Nvidia doing everything which is above board? This week we saw a lot of allegations of fraud and manipulations and accounting window dressing in Nvidia's earnings call. Did you see similar sentiment? Anyone want to chime in around, hey, these profits are not real profits? Or in your circles, you didn't see anything around Nvidia? Okay. In any case, there were concerns around Nvidia, and if Nvidia goes down, a lot of AI story will fall, and then we saw a lot of tech companies corrected a lot, especially the Mega Seven, right? And then overall, I think QQQ is down. What? Let's look at Qs. Where are we? Qs is down. Oh, come on. My think or swim is hung up. Is yes. Yeah. I don't know what is the case that I can't click on think or swim. Whatever. Maybe we can let's check on Google Finance. We'll know Qs.
The NDX is down by 7.42. SPX is down by 4.59.
So NDX is saying drawdown is 7%, right? Yeah, that's pretty common, right? 7% drawdown. It's not that it is down YTD. YTD, let's say QQQ is still up 15.5%. But if you look into the Twitter or Nyank has posted, given a link for a Substack or maybe CNBC, it looks like that bottom has fallen out of these companies. Okay. So first thing was that around the concerns around AI. The second thing was there is a increasing uncertainty that Fed will actually come with the rate cuts because we had a strong labor numbers. The numbers that came out, they were way stronger than what was anticipated. And I think there are no more payroll number, job numbers before the next Fed meeting. So the market was a little concerned around, oh my God, are we even gonna get the second rate cut in December or not? So I looked at during the week, I looked at the probabilities, the CME Fed Watch tool. The probability for a rate cut was actually down to 35 or 40%. It was less than 50%, right? Then on Friday, I think we had some of the Fed governor came in and told that probably they will be doing it. I mean, this was a little more dovish tone coming from one of the governors. And then the market was like, okay, I think we're gonna get a rate cut, and market was up. But in any case, I think the concern was around, hey, the December we may get a rate cut, we may not get a rate cut, which means all the growth stocks got cut if you have more uncertainty. But larger concern was around the AI. And John is asking, who is the Shanaka bear? Yes, that post has got more than 1 million views. So I do have what he posted on Twitter. So we'll go through it. So hold on your thoughts on that. Because it also came on my feed, right? And then I saw one of my college mates. He sent me on a WhatsApp and like, hey, what do you think about it? What the heck is happening? This guy had one post, and now I'm getting bombarded with that from different circles, right? So, uh, let's talk about it, right? Because right now the AI bears, they are out in full force. Let's see what they have to say about it. But before that, let's have a quick look at Nvidia earnings, right? And how the earnings did. If I look at just the earnings number, right, everything looks to be great. Revenue is up 62%. I know you can say, oh, come on, Nvidia is doing only 62%. We've been spoiled because over the quarters, Nvidia has done triple-digit gains, right? So 62% may not seem that great if you're comparing with Nvidia with itself. As compared to any other company, these results are amazing. And they still don't have China, right? I'm not going to go through all the results, but there's nothing in here that is cause of concern, right? And they have almost $60 billion sitting in cash. Top line, bottom line beat, increase the guidance. So it's like a triple beat. Data center revenue, which is what the street wants to focus on, That's up 66%. Right? And of course, they continue to do some buybacks and small amount of a dividend. Right? So from a result perspective, there was nothing wrong on the Nvidia's result. Right? And so the immediate first reaction we saw was after earnings, stock was up like 4-5%. And it's only the next day, I think, while some of the bears had time to digest, had time to go through their filings, they came out in a full force. The first one was starting at Michael Burry. Right, Michael Burry, now he doesn't run fund anymore. He closed his fund. He can be a lot more active on Twitter. So basically, he's talking about the stuff that we have talked about maybe now for a couple of years, which is these technology companies have been extending the useful life of their servers and hence getting a lower depreciation expense in every year or every quarter, which basically will boost up their net profits. So that's all he's talking about, saying you're understating the depreciation by extending useful life of assets, which artificially boosts your earnings. And then you come up with some number in saying, hey, by 2028, Oracle will overstate its earnings by whatever, 27%, Meta by 21%, so on and so forth. So this is nothing new. We have seen during the quarterly results, and I mean, they will mention that we have increased our server life from 4-year to 5-year, 5-year to 6-year, and all that stuff, right? So one concern is that maybe your gains that we see are not the real gains because you are understating depreciation. Right? That's one reason. That may be the case. The other one we're looking at, look at this chart. I found this today morning, which basically compares the spending CapEx, S&P total CapEx spending, less depreciation divided by the GDP. Basically, S&P 500 CapEx spending as a percent of our GDP. Right? And this is a dot-com or TMT boom, where we're talking about housing bubble, where we're talking about shale revolution in energy, and now we're talking about Gen AI. So the whole idea was, oh, come on, these CapEx spending, right, are they too big as a portion of our GDP? And looking at some of the historical numbers, you can draw some conclusions saying whenever these reach these historic peaks, we see that the market crashes. Right? So that's another theory around why this AI is bubble. And then this is the one which John is where he basically made a bold claim around this is a $610 billion AI Ponzi scheme that just crashed. I don't even know what you call it as a crash. We just looked at the QQ is down only 7%. I don't think that is crash, or neither Nvidia has crashed. At Nvidia, probably it's maybe max of Nvidia was $210 or something, right? So, but let's go through this because, like John mentioned, this has been all over the Twitter, right? So let's go through this. So he said last night, 4 p.m. EST, something unprecedented happened. Nvidia stock rallied 5%, which was after the earnings, and then crashed into the negative territory within 18 hours. Wall Street algorithms detected which humans could. The numbers don't add up. Right? So here's what they found. This is his claim. Nvidia reported this $33.4 billion in unpaid bills, which I doubt. It's not that Nvidia has not paid these bills. These are $33.4 billion of account receivables, right? So if you go and look into the balance sheet, it's $33.4 billion of account receivables. The customer who bought chips haven't paid for them. Average wait time for payment stretched from 46 to 53 days, which is basically called DSOs, outstanding DSOs. Basically daily sales outstanding, right? Meanwhile, Nvidia stockpiled $19.8 billion in unsold chips, which is up 32% in 3 months, right? But management claims Jensen Huang will claim demand is insane, right? We can't supply enough. We are booked until 2026, 2027, right? Both cannot be true. Either the customers aren't buying or they are buying without cash. So that's a claim. Third, it says cash flow tells the real story. Right? And I agree, cash flow in general tells the real story, right? So I don't know who said this. Maybe I read it somewhere that net profit is an opinion, cash flow is a reality. Right? So it's cash flow tells the real story. Nvidia generated $14.5 billion in actual cash, but reported $19.3 billion in profits. The gap is $4.8 billion, right? Nvidia converts only 75% of its profit to cash. This is called a free cash flow conversion. That's a distress level, right? And then he talks about here's where it gets criminal. Basically, they talk about the stuff around vendor finances, circular movement of money that's been all over the places. So basically what he says is same dollar circle through different companies, get counted as revenue multiple times. And then lastly, he comes around and says that smart investors like Peter Thiel sold $100 million of his stake in Nvidia. SoftBank dumped his Nvidia stocks. Michael Burry bought put options on Nvidia, and so on and so forth. And then it says Bitcoin, which tracks AI speculation, dropped from 126,000 to now I think Bitcoin is down to 84 or 85,000, right? AI startups hold $27 billion in Bitcoin as collateral for loans. So these were defaulted and they forced the liquidations on Bitcoin, right? Not my claim. This is who has written this, right? And then it says the timeline is now certain. February 2026, we'll have a fourth quarter. We'll figure out how many bills are outstanding, past 60 days. Credit agencies will downgrade Nvidia. April will have a first restatement of our financial. The fraud that took 18 months to build will unwind in 90 days. Fair value for Nvidia is $71. Current price is 186. Math is simple. This is the fastest moving financial fraud in history because algorithms detected it in real time. Human investors are 90 days behind. So the clock starts now. 3 months later, Nvidia will restate some of the, will report the results, some restatement will happen, and this fraud will start crumbling down. My question is, what do you think? What are your thoughts on this gentleman's claims around fraud and
he's short Nvidia and he cherry picked certain numbers, but he ignored the good stuff.
so yeah, I mean, I'm not, so the numbers are right. I mean, not some of the numbers are wrong. I would not say all the numbers are right, but some of the numbers are wrong. But you can look at, P&L statement and the cash flow statement and the balance sheet, and you can come to these conclusions. I'm not saying that he's entirely making it up, right? But the numbers and the conclusions are not related, right? So let's me go through it one by one. So first was that it's unpaid bills is the customers who haven't paid them yet, and he says the average wait time stretch from 46 to 53 days is conveniently not talked about the fact that quarter over quarter is actually come down from 56 days to 53 days. Right? That fact has been conveniently removed. Number two, it's not always the fact that your revenue cycle and your account receivables will match 1:1. Right? Sometimes, depending on your contract and your payment terms, things could change. That's why the DSOs will change. So I don't think it's that big a deal. If Nvidia was not able to pay its own bills, yeah, I would have been a little cautious in terms of why Nvidia is not able to pay bills. Sometimes it is possible that they got better terms, but I don't think this is a huge concern right now. Right. Let's talk about number two, where there's a stockpile $19.8 billion in unsold chips. Who said? I didn't see anywhere during the earnings. I reviewed the earnings press release. They don't say anywhere that it's an unsold chips. Inventory has gone up. Inventory is now $19.8 billion. That I agree. But inventory could be anything. And Nvidia has made it clear saying that, hey, we are also stockpiling to get ready for the demand that we need to fulfill. So I don't think that this is that it is because the customers are actually not buying the chips. So instead of listening to these Twitter heroes, maybe we should talk to the people who are in this industry, those who are involved in setting up data centers or running these data centers. You may see a completely different story that they cannot get their hands on NVIDIA chips. Okay. Third, cash flow tells a real story, which I agree. Right. But it is pretty common that your cash flow will be less if your number one, that if your account receivables has increased or if your inventory has increased. Both consume cash. I mean, inventory consume cash. Account receivables basically means you have received less cash than what you have sold for. So it's just if you can twist the fact on these two, you can twist and come up with a completely different narrative around the cash flow stuff. But I think the cash flow, and it says that NVIDIA is converting only 75%. Free cash flow conversion is only 75%. That is distress level. Come on, I've seen many companies doing much lesser. And those are still great companies. And I've seen companies doing more than 100% of free cash flow conversions also. So I don't think this is as a distress level. Right? Finally, one thing which I am little concerned, and I think we talked about, is all this circular financing. Right? I don't claim anything that is criminal going over there. I don't think, but it's a common. I don't think it's a common practice, but there are ways even in outside of the tech companies where the same good could be sold multiple times and multiple companies may report it as a revenue. For example, if you, let's say, if I'm a retailer who's selling the goods, I report the selling price of the goods as my revenue, but I would have sourced that goods from some manufacturer. Manufacturer would have reported the sale of its own price as a revenue. That's how the business works. But what you need to focus on and what is been conveniently missed out here is that there's also cost of acquisition, right? So if I'm a retailer, if I'm a Walmart, I'm claiming that I sold a goods for $100, but then my cost of acquisition of the goods, whatever, it's $80, which would have been a revenue for the manufacturer who sold me the goods. So you need to look at not just the revenue growth, and this is where a lot of people do mistake, as completely look at the revenue. You can always buy the revenue. But look at an Nvidia. It's not just the revenue is growing. Would have been concerned if revenue is growing and profits are stagnant. But damn, their net profit also grew. Right. So that claim goes out of the door. But is there any circular or vendor financing kind of stuff going on? Yes. That is a little concern to me, that Nvidia has to basically give a stake to or take a stake in another company, give them funds, that company turns around and buy Nvidia chips. So I'm a little concerned on that one, but that's not a fraud. That's not criminal. And Jensen Huang is very particular in saying, hey, we want to make sure we basically own piece of the whole ecosystem. And there's nothing wrong in doing that. Okay. Finally, they talk about Peter Thiel sold this, SoftBank sold this. They could be selling for any reasons. I have seen many smart investors selling the stock, and then repenting later on, right? A lot of fund managers had dumped Chinese stocks. A lot of fund managers have dumped Google when Google was trading at $140, $150. Now they're back up and say, oh, come on, Google is the best company on the world, right? So I don't read too much into why Peter Thiel, sold $100 million. I also see there are a lot, it's not just Peter Thiel, a lot of investors have sold, and it's okay to take gains. I know that SoftBank, because they sold because they want to invest and give money to OpenAI. So saying, oh, Peter Thiel sold and Michael Burry bought put options, that means Nvidia will crash. That's a very lazy argument. Okay. Final argument around Bitcoin. I don't even know where this is coming from. At least I've not seen any confirmed reports of that these AI startups have Bitcoin. They hold so much of Bitcoin on their collateral. Now, there's a different reason why Bitcoin had gone down. If you listen to Tom Lee's talk about the stress that they are seeing in the market makers, that had nothing to do with these AI startups. So, like someone was saying, right? Maybe he is short on this stock, and if I short on the stock, I mean, I probably still have to wait to make money because Nvidia has done fine. So, but these are the posts which will get like more than 1 million views and like, generate a lot more excitement than what may be a reality. And I'm not saying this is like one thing which I am concerned about here is this whole vendor financing stuff. And the main important thing which he has not mentioned is where's the ROI? Which is what I'm concerned about is, are you ever gonna make money? How are you gonna make money on this? Right? When Sam Altman was asked the questions, he had no answer to it. That I'm still concerned about is justifying the ROI on it. Maybe we are too early in the game to even think about that. How are we gonna get, whether these companies may be able to do it, may not be able to do it. Maybe it's too early a question to ask. But that I am concerned about is, how are these companies going to make money? Nvidia will make money. I'm concerned about the overall ecosystem. The companies that are buying these Nvidia chips, trying to build AI solutions, is there an ROI eventually which they will get or not? And if they won't get it, then they will cancel their order, then the Nvidia will get impacted. And then all the CapEx, which, a lot of these companies have committed to, like Google's of the world, they've committed so much of a CapEx, they will gonna come back and cancel the contracts. Then the Nvidia will get impacted. But it will be, in my opinion, that would be a downstream impact because we are not seeing any ROI from investments, right? MIT says 95% of the AI projects just don't deliver. So
Vivek, how did he get this fair value of 7?
who knows? How did
Because
that person got the fair value?
there's no justification.
I mean, I've not gone through there is a link to a further longer document. I
Oh,
didn't want to
okay.
waste my time and energy on that one. So if you have access to the tweet, or I'll put this tweet link. I think at the end of a tweet link, he has also given a link to his Substack or something. But that's where he might have explained. But I didn't want to spend too much energy. But the reason is that I got not only that this one showed up on my Twitter thread, but some of my friends reached out to me and said, "Hey, what do you think about it?" I'm like, "What the heck?" Then I thought maybe I will bring it up in this meeting. And then, you asked about who is this guy? I'm like, oh, this is like all over the place. Yeah. But am I worried about this AI stuff? But I've been worried about it like for last 6-7 months, right? It will take much longer to play out. So at the end of the day, it's all about position sizing. Right? I know what is Nvidia trading at. If you really look at it, currently Nvidia is probably trading at 26 or 27 times the 2027 forward earnings. Pretty reasonable, guys. That's not too speculative. 26 times. which is very different than where the Cisco's of the world were trading to the dot-coms. Right. So Nvidia, I don't think is a very expensive trading as very expensive valuation. I'm not talking about a lot of other companies. There are a lot of froth in other companies. Hopefully, some of that froth came out over the last 2 weeks. Right. There are companies which have zero revenue. There are companies which have like one big customer and they are trading at like 10 times, 20 times sales. My favorite Palantir is trading at, I don't know, maybe 80 times sales now. I think it is still expensive. I made a lot of money in Palantir, so I can't complain. But some part of a time you say, this doesn't make sense. Palantir doesn't make sense. Nvidia, it still makes sense to me. It's not that expensive as some of the companies in dot-coms were. I think the most favorite hobby of armchair investors like us is to draw the comparison between Cisco and Nvidia, right? But if you dig deeper, then just don't bring the charts, right? But if you dig deeper and look into the valuations of what kind of companies these companies were two different companies. Maybe we'll have someone else as a Cisco. Who knows? Right. So interesting one. And then I saw Dan Ives. He also posted a letter to, I guess, AI bears, I would say. So his was around in 2008, most investors denied that Apple iPhone was going to be anything more than 1 year AT&T-led mobile phone cycle, given that BlackBerry owned the market at that time. And I think there was another stat. When iPhone came out, the street whisper number was, I think, 375,000 iPhones in the quarter. They did 250K. So it was pretty bad. They missed the number by a lot. And then the street was saying, okay, this is just a fad. They'll never be able to scale. They mocked Netflix in 2007 and Reed Hastings on concept of moving from DVDs to streaming and crashed the stock accordingly. The concept of Nadella taking Microsoft to cloud-focused company was considered a fantasy. Investors mocked the concept of Zscaler and CrowdStrike as disruptive private companies because we already have a Symantec and McAfee dominating the industry. And then finally, skepticism of Jensen and Nvidia spending massive R&D dollars on AI in 2021, 2022, where they should be focused on core gaming market. I wasn't tracking Nvidia. I only bought Nvidia shares after the ChatGPT came out. So I don't know what folks were maybe doing in 2021. I know they were a little bit mocked about, I mean, their chips were highly in demand because a lot of chips were used for their Ethereum mining. And then they came up with a separate chip for Ethereum mining. Also related, the fierce criticism Nadella Microsoft got by Street in January 2023 with its $10 billion investment in OpenAI. That OpenAI stake is now $135 billion today. In a nutshell, this AI revolution is just beginning today. We believe tech stocks are the AI winner, should be bought given our view that this is year 3 of what may be a 10-year AI cycle. Again, Dan Ives has been a huge proponent of the tech investing. But remember, Dan Ives doesn't run your house. He's not responsible for food on your dining table, roof over your head. So you do what you think you can sleep well with. I just bring out these bears and the bulls to help you out in look at the both viewpoints. But at the end of the day, you have to decide what works for you. You have to decide if Nvidia goes another 20%, are you going to lose sleep or not? Even though it is okay that Nvidia might become 3x in next 5 years. But what if it goes down 40%? If you're going to lose sleep or you're going to lose roof on your head, then you may want to decide that I don't want to have Nvidia in your portfolio. Yeah. But if you have an opinion saying, I don't care, Nvidia can correct. But as long as I think it's going to be multiples of where it is today in next 10 years and you're willing to hold through that volatility, maybe this volatility is then an opportunity. So that is, I'm very skeptical of just coming out and saying, yeah, this is a great buy. And this is what I hate when the CNBC, these anchors and the guest on the CNBC will come and say, oh, X company is a good buy. I'm like, for whom? Is it good buy for the person who's retired? Is it good buy for my kid who's just starting its financial life? Is it good buy for me who left his job, is only surviving on investing income? For whom? Right? Uh, because it's very different. That's why I just can't make a blanket statement which stocks one should buy, because I don't know your personal situation. A great stock for my kid could be a terrible stock for me, because my kid, she's working. I am not. So if the stock goes, my portfolio goes on 50%, I'll be in trouble. The others who have another source of income and another 20, 30, 40 years ahead of you, it's okay. So I can tell you. But yeah, a lot of, I would say, chatter in the market around AI and what's happening there. Any other thoughts on AI? Jose says it hasn't crashed yet, but don't you think we're about to roll over for the year after this next rally? And if we get one, sorry, let me see if there's any other question. Sorry, Jose, can you ask that? I'm not clear. Or maybe
I just think that we're still in a bull market, but the fact that we're having all this volatility is showing signs of exhaustion.
Oh, okay. Tom saying short-term trading basis, hands off as long as the current day low is lower than prior day. Okay. They call it allocation, not sales. When your sales are received as allocation by your customers, you're operating on another stratosphere. Alan says, we can still say that the end consumer is not being charged as much as possible. So the circular deals can pan out much better than how people are considered. And in NVIDIA numbers, there are no China numbers. Right. So, and and I think on Friday, the market was up like near 10 or 11 o'clock. I actually left my home at around 11 o'clock on Friday. So I was just on my phone. I was watching. Market was up because I think there was administration was saying maybe they'll allow NVIDIA to sell some kind of a chips to China. Definitely not Blackwell, but maybe the lower ones, right? Now, and there is no China revenue included in NVIDIA. Right? So, yeah. JSA Palantir is down 23% for the month so far, but I think it is still overvalued, right? It's still over expensive. Apparently, there is a lot of put flow short term for NVIDIA, just in case you were interested to TCA to get a better pricing. I didn't look into the put call ratio in NVIDIA, but it is possible that there'll be many followers of Michael Burry. And overall, if you really look into the I think will show the fear and greed index. And one of the component in fear and greed index is your put call ratio. And that was like an extreme fear. I think the last time I saw these numbers so low was around April during the Liberation Day. Right. So sometimes these opportunities are good opportunities. So I did increase a little bit of my deltas in the portfolio, but I think I saw as low as 6 fear and greed index. Okay, Bob is asking time to invest in BDC. How would you feel if it goes down to 10K, 20K, or to 0? So still, it could go down to 0 or it could go to million. It's a very wide range. And if you're not comfortable with these two scenarios, maybe then stay away. I'm comfortable with these scenarios, so I will still be invested. But my thesis time period is 20 years. And the amount of investment that I'll have in it over 20-year long time horizon doesn't matter much. So, but if you were not invested in, and if you're okay with these scenarios, yeah, it's been much cheaper, available much cheaper. One big risk that we still have is around, oh, of course, there are a lot of risks coming around the quantum side. The other one which they're talking about is what if MSTR has to wind down its position. Right? But I don't think MSTR will have to wind down the position, because a lot of the financial engineering that they have, not all of them are guaranteed dividends preferreds, right? So the more concern could be a lot of other funds that bought MSTR, if they are not getting the whatever the fixed income that they were projecting for, and if they have to sell something, that we may have a much bigger impact. But MSTR can still survive even if the Bitcoin goes lower than whatever. Their average cost of buying is, I think, around 70K. And on Twitter, you will see where people claiming if Bitcoin goes below 70K, Michael Saylor will start selling Bitcoin because now if it is trading, and maybe buy back his shares. I don't know. I don't think, I mean, he is claiming that he's not going to sell, but for paying out the dividend, etc., on preferreds, or whenever the convertibles will convert, I think there's still a long time. I don't see any risk from that perspective. Yeah. All right. What if MST has taken out of index ETFs? Yeah, so there has been discussion going around MSCI, right? Wherein I think they have invited some thoughts around it. And probably maybe the decision need to be taken next year or end of this year. I did read somewhere wherein they are saying that if your company has got some certain percentage of either the revenue or the market cap, or the assets is in digital assets, then they will take it out from their index ETFs, right? So if they take it out from index ETFs, now I don't know how much of flow came in, because MSTR was part of, did it become part of NASDAQ? Right. Which index is MSTR even part of? I don't know. I don't think it's a part of S&P. Maybe it became part of some big ETF. Was it NASDAQ or which one? Again, a lot of investors that are buying MSTR, it was NASDAQ, okay? They probably have a direct investment in MSTR, right? Because MSTR was considered as a proxy of Bitcoin before we had Bitcoin ETFs. So there's a lot of investors or funds had taken exposure to MSTR, either directly on the stock side or convertibles, or now with the preferreds and all that stuff. And so taking out it from an index ETFs probably won't make much of a difference. I don't think there's a lot of flow coming into MSTR from an index ETFs. Now, so we'll see. Anyway, I'm not, as long as there is not of a big selling coming from MSTR, who cares where MSTR goes? I was never a big fan of MSTR as a stock ticker. I'm still not. If you want an exposure to Bitcoin, there are easier ways which will give you direct exposure to Bitcoin. So why do you need MSTR anymore? I don't want to deal with financial engineering or whatever Michael Saylor is trying to do. It adds a layer of what he wants to claim, higher volatility and leverage, but then these things cut both ways. So I am happy to own IBIT. I don't own MSTR. Anyway, so I also got to try Nanobanana, right? And I was like shocked by this. So I uploaded the press release, the earnings release, into my Gemini Pro account, and I asked it to create an infographic. Pretty great, right? And the numbers are all right. I checked the numbers. So numbers are not hallucination, but I'm like, cool. It's gonna make a job of lot of either it's gonna, render a lot of junior analyst out of a jobless, because now you can ask this. If you have to put a deck of a summary of Nvidia, you can just ask Gemini, or I guess maybe other tools are also equally great on these. And all I gave was, hey, give me an infographic that distills the information that I can present to investors. Kind of a similar, I had a prompt like this, and the Nanobanana gave me this one. I don't think if I were to sit and do it, I wouldn't have been able to come up with this. And it would have taken me hours. But these things are like mind blowing. Right? So anyway, and this is where we say, hey, we're just getting started. Right? We didn't even know about this. So lot more to go in terms of, I'm pretty excited about all the things that I'm seeing in AI. In terms of how easier, or how productive it is making all of us. And yesterday I had to make some change in some of the script, because some of the Google sheet that I have was becoming slow. And then, all I had to do was ask. It'll give me, oh, right? It's all the code generators, right? It'll give you everything, all the scripts and all that. I remember spending hours pre-AI days. Right? Am I becoming dumber? Sure. I don't look for what's the right syntax, how do I use it, and all that stuff. But I'll just tell them, hey, this is a problem. I want you to give me the script which will do this and this. Boom. And when I was asking which one I'm using, so I use Gemini. And the reason I got paying $20 for Gemini is because it also gives you 1 TB of free Google Drive for 5 accounts. And our family, we were just running out of space. So you could use ChatGPT. I think OpenAI is also maybe even better in some tasks. OpenAI is even better. But these tools are amazing. It is helping us so much in our investing process. Would have taken like hours and hours of work to do this. But the whole dream of you'll have a tools to do this so that you can enjoy and sip beer or pina colada, that hasn't turned out to be true, because now I spend more time in analyzing a lot more companies or doing a lot more stuff than, hey, AI did this for me, let me take this time and go and enjoy. Anyway, so that's on the AI side. Another interesting chat I saw today morning from 314, Warren Pies. He's a frequent guest on CNBC. Is number of S&P 500 members which actually beat S&P, right? Gosh, look at this. This number has been going down slowly and slowly. 2025 we are here. It's only 158 stocks are outperforming S&P 500. And this is why I am, even though, I love to analyze individual companies, my biggest holding is still S&P 500. There were times where maybe you could have beat, it was easier to beat S&P, not anymore. And especially in last 2 years as a fund manager, I'm not fund manager, but if you're as a fund manager, if you had not owned like a couple of these Nvidias and related companies of one of these Metas and the Nvidias of the world, you could do whatever you want to. we wouldn't have been able to beat S&P 500. It's so difficult. There are a handful of stocks, like 10 stocks that is run like now 40%. And like those big stocks keep getting bigger. So one of the, I don't know where I heard, which podcast or which guest was it, but they were talking about, all these bears that we are seeing now. These may be salty people who missed out on this big rally on AI, right? And now coming out and say, oh, you see, I told you, shouldn't have been in this. I don't know how much truth is in that, but they say if you missed the social media rally, didn't invest in Meta, and now you're also missing this whole AI rally, right? What else are you gonna do? Right. So, and so the life of active managers is very difficult. I sympathize with them, man. It's not easy to beat S&P 500. On the flip side, as a retail investor, it's a great thing for us. Right? We can do better than most of the fund managers by just buying and holding S&P 500. Right? And they also said there are more stocks that are trailing index by more than 20% or more than the one beating it. Are there some stocks that beat index? Sure. I mean, these Nvidias and the Metas and the Google is up like 60% for the year. Sure, they beat an index. Right? But long term, but there are, even for today, there are more stocks which are actually trailing the index. So either you have to be really good in terms of picking the winners for the long term. Because over 100 years history, 100 plus years of history of stock market, only 4% of the stocks have resulted in 90% of the gains. More than 60% of the stocks have underperformed cash or T-bills. More than 60% of the stock, like more than 2/3 of the stocks have underperformed T-bills. So it's not, that's why investing is not easy, especially if you're doing the individual stocks, very tough over long term. And I'm not that smart to pick up those 4% winners. So I'm happy as long if my SPY continues to become bigger and bigger portion. I think I'm perfectly happy with that portfolio composition. But here on Twitter, on YouTube, you will see a lot of new investors talking about, I'm going to beat S&P, make 50% year over year. I don't know. People are not happy with making 10%. And they're like, oh, come on. I got to make 50% year over year. Gosh, I don't think that's possible. I've not seen, except maybe Renaissance, anyone else do it consistently year over year. Warren Buffett did 30% plus. But anyway, people get excited. When the markets are up, people get excited. They think making 20% year over year is like a child's play. Right? Try to do it when the big portfolio start to become bigger. As your portfolio start to become bigger and bigger, it becomes very difficult to grow at the same rate. Right? And you know what I'm saying if you've been through that journey. It's very easy and to come and say, I'm up like 100%. But I see this on Twitter many times, up 50% for the year, 80%, 200%. Yeah, maybe you have $10,000. If you like your portfolio is like 20, 30, 100 times more than that, just ignore it. Yeah, Shri, go ahead. You have a question?
Yeah. Couple of things to think about. S&P 500 is a market cap index, and it keeps changing year after year. When you compare that to the RSP or the equal weight index, it's entirely different.
Yeah.
Does the small cap index or the equal weight index, is it ever going to outbeat the S&P 500? should you be even thinking of beating the S&P 500 index in 1 year, 1 month, 6 years, whatever time period? Nobody can beat the S&P 500 year after year after year. But if you're taking into consideration for the longer time period, you can beat the S&P 500 index without any problem. That's my idea. I mean, again, if you see Berkshire Hathaway's returns, it's not been 30% all along. He has had several years where he has lost much more than the index itself, the S&P 500 index. Majority of his returns were earlier years when he started. So
Yeah.
those are the things that needs to be considered also.
No, all fair points. And in terms of the composition of S&P, and I like the way S&P composition because it means the bigger companies have a bigger impact on the index. But it will cut both ways. If those companies start to go down, you will see a larger impact on S&P 500. But and you're right, it's not easy. I don't know, why did you say that so did you say that it's easy to beat S&P 500? I don't think so. I mean, I'm of opinion it's very difficult for a common investors to beat S&P 500. Unless
if you keep on developing an idea how to select the stocks that are outbeating in the 3 months and 6 months against the S&P 500 and hold them until they drop below the S&P 500 or the relative returns, basically, and then you can get out of that particular one which is not beating the S&P 500.
So-
You might be able to do that.
so one
And there are other things that you can do also using the option strategies too.
True. Yeah, that using the option strategies then involve a lot more work than just being a passive investor. But one thing I think I would like to add to this is every time you sell or buy, make sure you also account for your taxes paid and then what's the capital available to sell. Most of us as an investor ignore it, and I used to ignore it. I never paid too much attention to the taxes side of a thing, saying, oh, come on, if I've made some gains, I have to pay taxes only if I'm making some gains. But what I did not realize is that at the end of the day, the portfolio gets shrunk because I have to pay the taxes for future compounding. So anyway, I just look at, rather me trying to figure it, I just look at all the research that way more smarter people than me have done. And I think most of them, it points out to it is very difficult because very few stocks account for bigger gains than S&P over the long period of time. Of course, when I say long period of time, I'm looking at 20, 30, 40 years investment period. There are, which will be consistently being able to do better than S&P 500. So, and that's the reason, if you look at as SPIVA reports comes out, I think twice a year. And every year by year, like 60%, 70% of the Wall Street fund managers just can't beat S&P 500. And I'm like, as an individual investor, I don't even have those resources which Wall Street fund managers have, right? And I'm trying to dream about, beating S&P 500. Now, are there years where I will be able to beat? Oh yeah, I mean, even this year also it's been much better than S&P 500. But it is because probably I was on the right stocks like Meta and Google. When everyone was dumping Google, yeah, that was the time to buy Google and all that stuff, and that has worked out, right? But who knows? 10 years later, where the Google will go? I don't know. Who knew that? That the companies like now the stock or like Starbucks or any of these big companies, Sears will go bankrupt. When Sears were at its peak, nobody could even Think about it. Who could have thought that IBM will be, take out the last 2 years, IBM will become like a common company, won't even impact anything on the tech market. No one could have thought in 1990s. So that's why I'm increasing more allocation to S&P 500. And because I don't know who the winners will be 10 years later. Anyway, so let's move on, look at fear and greed index. So like I said, I think this is as of end of Friday, which is number 11, which is better. I saw it's as low as 6 or 7 during the week. And if we were to deploy some capital, these are the times when it is in extreme fear. These are the better times to deploy the capital than when it is in a greed on extreme greed phase. Right? That's just me. I tend to become, little more. I'll pull out in terms of adding more capital or adding more deltas when the market is in greed phase. I'll do a lot of negative delta trades, selling calls, maybe become a little more aggressive in doing covered calls, or even in case of a naked calls and all that. However, when it is an extreme fear, I close down a lot of my calls, added some more puts, increase the overall bullishness of the portfolio by 10% more than what I would generally have.
Vivek, if I could ask, please, what was the lowest you've seen that extreme fear reading, perhaps back on April 7th?
I think it's 4.
4 is the lowest you've seen? Thank you.
Yeah, 4 or 5, yeah. And this is the lowest since April. And I don't think the situation is that bad, right? But the idea is, but once people have seen these gains, and then the market is down, and I don't know where people get into. Did they get it at the top, and now they're concerned around it, concerned about this little bit of a correction? You never know where the people are coming from. All I can look at is, dude, my portfolio is still okay. We might have lost a few weeks, like couple of weeks. Who cares? But yeah, I think 4 was the lowest during the Liberation Week. Now, this is what I was talking about, right? Come on, even if you just pick S&P 500, you're still up like 12%. I think this includes dividend, I guess. Right? What more can we ask for? We're doing better than the long-term average, which is 10%. Now but if you held companies like BMNR, and I know, like when the stock goes up, I see a lot of questions around, hey, how about this? How about Kava? And I was like, guys, don't get into Kava unless you understand what you're paying up for. How did that work out? Because when it came to IPO, it was all the rage. At this point of time, the market cap was like as a $50 million per location valuation. And if you look at Chipotle at the same time, it was like a $3 million per location. What on earth is Kava's individual locations are worth more than 16 times the Chipotle's location? Right? Some of you might remember. You asked me why you're not in. I think we reviewed Kava's S1 in the meeting, right? And then the stock went up, and like, why don't you own it? I don't want to own it. It is super expensive. S1 was okay, but then when the stock ran, I'm like, I can't own it. I generally don't own any restaurant, because restaurant, in my opinion, are very difficult in long term as a business, and I don't understand the competitiveness of these. So I don't have Chipotle, I don't have Kava, but when I compare these, I'm like, come on. Right? But yeah, people get excited. And if you had owned Kava, or if you had owned the latest new fad BMNR, right, after Tom Lee, yeah, and I see people like, oh gosh, I'm down 60% on my portfolio. Yeah, you should have known what you're owning. Market is still fine, guys. Market is not that bad. Up 12% is more than what, I mean, we should consider ourselves lucky that we are in the US, that over the last long term markets have done great. But I think there was a comment saying international has done better. Yes. Is it the time that the tide has turned? Because I've seen the whole story around internationals will be better, emerging markets will be better, China story, India growth story breaks. But over the last 20 years, it's the US market that has overshadowed all of them. I still own emerging markets in my portfolio. But the fact is that 30% of the S&P 500 revenue is generated outside of US. So even if you own S&P 500, you are still be able to get exposure to something outside US. Right? So I don't think that this year has been bad for the markets. Numbers speak for themselves. Right. So what did I buy or sell? I got IBIT assigned. We were talking at the start of a session when Aditya said he got a, so I took an assignment in short put, because I think that right now there's an extreme pessimism around all the things that are happening in crypto. So I'm like, okay, I'll hold it. And I'm okay to hold it. And that's where the cash helps. And if it goes back up, I don't know if it'll go back up or not. But I'll start selling options and reduce my cost basis. I can't control the market. I can only trade or do in the market that what the market is. Second thing which I bought was Mercado Libre at a put spread, and it completely closed in the money. So I closed my put spread for a loss, but I bought the stocks at lower price than whenever I put this trade. Okay. Again, these are not recommendations, but at the end of a month, I tell you my portfolio. So you know that if you see Mercado Libre becoming bigger part of my portfolio, it may be because, yeah, I added more, right? And then what did I sell? I had General Motors. I took an assignment on covered call. Now I'm out of General Motors. And I know some of you folks from Michigan don't hate me for that. My thesis behind General Motors was their Ultium battery and focus on EV. I want to spread my bets on EV. And that's why I took General Motors and Ford. And now both of those companies have gone back on their EV. And I have no reason to own it. That was my thesis. Not a ding on General Motors as a company. Good dividend payer, probably stock might do better. But my only thesis was I wanted to get an exposure to EV. And I was spreading my bets. Over long term, auto sector is generally a low margin business. I'm not interested in investing in auto sector as such, except a few niche companies. Auto sector is not a great for investors, just like airlines are not a great investment. Right? So my thesis, Mary Vera, she busted my thesis saying we're gonna go slow or completely out of EV. I thought I've been selling covered call for last 2-3 months. Finally got a send. I'm like, okay, take it away, take it away.
Vivek.
Yeah.
Question. I don't see how these union-owned companies could be profitable. What I mean is like the U.S. Airlines and GM, Ford, and they're more or less owned by the unions. So how can they be vastly profitable?
I don't know about vastly, but I think they are profitable. The GM generates a good amount of a cash
Oh,
flow.
I mean stock price go up a lot.
No, not stock price. I'm not talking about stock price. If you look at GM, they generate some good cash flow, like 23%. They have 7% cash flow margin. So, but I just didn't want to. Here's a concern. If GM had not a few years ago, if they have not announced that EV plan, would I bought GM? No. My only reason I sold GM was because, hey, now they're going back on EV, which was my thesis that I wanted to get in because they had some EV play. Now that EV play is no longer there, I'm out. Not a ding on GM as a company. It's a stable company, will give you dividend because they generate enough cash flow. Probably can't see a growth. Now, if they're not EV, I don't know where they want to get a growth from. So probably they'll buy back a lot more shares. So the investor will still be fine, but just that it doesn't gel with my thesis. And all depends on what kind of investor you are, right? So, okay, so these are the two, Aditya. When you close Melly, put spread for loss, buy the stock. Sound like one of the legs got breached. Both the legs were in the money because the Melly has fallen so much. If you look at Melly, the stock has fallen so much that both the legs were in the money for me. So I had, I think, 22, I had like $40 wide or $50 wide put spread. I mean, I started with the iron condor, so I had on both sides, and then it kept falling, and bid-ask spreads are so wide in Melee that it's adjusting is almost impossible. So I'm like, whatever. If it falls down, I'll buy the shares, take a loss on the option, and buy the stock at lower price. So that's what I did. But I'm still bullish, so I'll hold the stock. Recently, they announced a mixed shelf offering. Not announced, but they filed with the registration, whatever the authority in Brazil and Argentina are for their mixed shelf offering. And I think market has got a little spooked. Oh my God, they're gonna dilute the shareholders or they're gonna take a lot of debt. But if you recall, their credit business is growing much faster. So they want to make sure that they have ability to draw on those. This is generally, I'm not from this industry, but I know this is called like having an ability to warehouse the capital. So if you have that warehouse available in terms of mixed shelf offering, you can take and raise the capital when you need to, right? And this is a mixed shelf because they said maybe we'll do stock, maybe we'll do debt. And recently, I think maybe a month ago, 2 months ago, somewhere between, the Melly's corporate debt rating, they got upgraded. I think now they are investment grade, triple B plus. So they may be doing mixed shelf offering so that they can retire the more expensive debt with the newer one, which will be less expensive because now their investment grade is improved. Right? So there could be many reasons. So I focus on business. Business has been doing great. It's been a great compounder for me, and I'll hold it as long as business doesn't deteriorate. I don't care where the stock goes. The average stock I trade is under 20 Melly. So I first time I bought Melly was around 350. So I've been in this stock since then. And my biggest regret is I think I bought like 100 shares and it became 580 or something immediately a month or maybe 2 months after I bought it, and I sold some portion of it. And I'm like, oh, I should have just held all of my portfolio. It would have taken care of all the losses that I have in all the takers. Right? This is one example where I have my bigger regrets are selling some of these multi-compounders to protect or to capture the gains. I think in long term, I think I lost a lot more on the opportunity side than I would have lost. I had lost on the real gains on the duds that I still hold in my portfolio. I mean, I have some stocks which are down 80%, right? I'm like, come on, what it can go down more 20%, right? It can't go down below zero. The beauty about the stocks is it can't go down below zero. So I'll hold it. Right? So I don't know. What if some of them turn around and become daggers? Like I didn't hold, but let's say Carvana has become. Like went from 350 to $2, now back to whatever 200 plus $300. Not that I'm a big fan of Carvana, but these things do happen. So yeah, so over I think 2023, I decided that I want to hold a minimum portion always in my portfolio for the stocks whose business are still doing good. Yeah, I'll sell calls. I'll try to take, if I see it's overextended and whatever, it's up more than 100%, it's 200-day moving average or whichever numbers you want to. Yeah, I'll sell some, but I'm not gonna take full profits. Okay, let's look at the crypto side of the house. Not that great. We are now $2.97 trillion, almost 500 billion got wiped off since our last meeting. Bitcoin is 84K. I mean, nothing else changed. I mean, the overall leadership board hasn't changed much. I did hear Tom Lee talking about on what's happening on the cryptos, what caused all this mayhem in the crypto side. I'm not sure if I'm completely convinced of it. But Tom Lee is Tom Lee. I mean, he's got big street credentials. Probably he knows a lot more he has a lot more insight, understand this markets in terms of how the market makers and everything work in this space a lot more than I do. But he was talking about that the current distress that we are seeing, it started on October 10th. I think there was some big liquidation event that happened. And the distress that we see was because of some market makers got upset down, so they had to lighten up their balance sheet. And that happened because of on some protocol, I don't know which one he was talking about, but I don't think he specified one. But one of the stable coins got kind of a deep peg that caused a lot of this churn. And if you're in the crypto market, you have automatic liquidations happening, right? You don't even get a margin calls. Like on the stock side, you'll get a call from your broker saying, hey, you have to pay up the capital, otherwise we're going to liquidate or your holdings to raise cash. Crypto side is automatic liquidation margin, right? If you take on a loan and if you're and if the underlying which you have given as a collateral is Bitcoin, and the Bitcoin value has fallen down, and if your LTV goes lower than what the protocol supports, they'll automatically liquidate your holdings, right? So that's what Tom Lee was saying. There was automatic liquidations, and the market makers got impacted, and they had to lighten up their balance sheet, whatnot. Again, he is a chairman of BMNR. So he may be trying to placate the markets. We don't know what his intentions are. He's a great guy. He's got calls about the market right than many other folks. So hopefully he's right. But my thesis is still the same. It's a long-term game. I'll wait for another 10, 15 years for it to play out. Anything below that is pure speculation, because it's way, way early if this is supposed to work. If not, yeah, then it's a big experiment that failed after 20 years. But I'm ready to participate in that experiment. Cool. Other thing they were also looking around was, the question was, is Bitcoin a diversifier? You're looking, can it give you diversification? No, the relationship of the Bitcoin and equities have changed. It has changed after 2020, because then, this article talks about, it shows you the correlation and how it has changed. Because now if you look at after 2020, the correlation has become bigger, higher. It means it is a lot more correlated. It is now more correlated to your movement in S&P or NASDAQ. That is why you say, oh, it's a higher beta tech company. Right? That's a common statement that's being made. And now why the relationship has changed? Because now we got institutions coming in. Right? Prior to 2020, it was all degens, retail investors trying to play in the market. But now we got a lot of institutional acceptance. MSTRs of the world came in. Then the funds that have invested in MSTRs, family offices, hedge funds, now with the ETF, Now you can buy ETF, like it's a part of our portfolios. It has gone into people's 401k, right? So a lot of institutions have come in, and now number two, it become a part of your regular portfolio, right? It is integrated with your portfolio. And now if you see your portfolio is getting red, you'll try to say, oh, which one should I sell? And human psychology is to sell the ones where you've already made the gains, right? You feel better, the dopamine hits you. The joy is twice or thrice more than the, trying to sell a losing one. So you will sell what is what. So yeah, it's become part of regular portfolios, and hence it has become more correlated to how the rest of the market is, right? Same in the supply and holding patterns. So that's why I'm not surprised that if we see a weakness in the market, Bitcoin also sells off, because now it is part of our bigger financial picture, right? Including me. And a lot of degens are now claiming that these Wall Street people are killing us. These ETFs are killing us. Ever since ETFs came in, Bitcoin probably is going down because BlackRock is killing us. They are taking money away from retail investors. So this is a screenshot from today morning, right? ETF saw net inflows, right, on Friday. Overall, these ETFs, these are very, what do you call, pretty stable holders, right? Asset under management is 65 billion. These are pretty stable, total $110 billion in it. And year to date, it is actually up. Inflow is actually up. Whereas Bitcoin has gone nowhere. I mean, probably it is down year to date, I guess. It has gone nowhere since the last November, since the presidential election. So institutionalization or coming of ETFs is not what's causing this. It is, I think, the regular OG, call it OGs or the degens, the sale of crypto asset on the exchanges. That's where a lot of outflow is coming from. It's not the ETFs. Right? Whatever you may want to think, that's not the real case. It's not the Wall Street is killing us, or BlackRock is trying to shake retail investors out. No, BlackRock has got enough, like $65 billion in IBIT. Not much. They didn't have an outflows. All right. So let's talk about private credit. So I think SEC commissioner is making case for why the private credit and the private equity, private market should become a part of 401k. And if you recall, our beloved president did an executive order in August in saying, to democratize access to alternative assets. Basically, this executive order says that now 401k providers can also legally allowed to provide access to private credit to the companies, right, as one of an options. Then there are studies are being done, which says private assets in 401k is a modest help for investors, so on and so forth. So I don't know, maybe you should look at your 401k and talk to your HR saying, hey, are you allowing private credit in my, in my fund? Is it by default or not? So let's talk about that, because over the last few, almost a year, I think it's almost a year. At the first time we heard around the murmurs around private credit for retail investors was in 2024, May, June timeframe. Then I think I also covered once in November because it keeps growing. Everyone wants to give access to private credit to retail investors, democratize the investment opportunities. You don't have to have a family office. You don't need to have a rich uncle. You don't need to have a friends in Wall Street now to get access to private credit. So before you participate in it, let's talk about what is a private credit, right? There was a question, what is private credit? So first of all, what is credit? If you want a credit, what do? You go to bank, take a loan, right? So the name of the loan is credit, right? But what banks will do, they will check what's your FICO score is. Maybe they want to look at what your assets are, how much of a loan you're taking. Either look at a loan to value, and they say, nah, you're not good. I'm not going to give you credit. I'm not going to give you loan, right? Now, prior to 2008, banks were a little more generous. And this applied to mostly businesses, not any individuals, right? Now, if I'm a business, I run a business, but my books are not that great. My risk profile is a little higher than what banks would like to do it. Where do I go? I go to non-banking stuff. Prior to 2008, banks used to lend to some of the, riskier businesses, the businesses that, may not have even the business have their credit scores. I think Dun and Bradstreet, they do it, right? So they used to do it, but after 2008, regulators who've been saying you can't do all those stuff because now you're systemically important for US economy. We need to regulate you. You can't do all the shit that you guys were doing it. If you're doing the loans, if you're giving, credit, you need to make sure these things are in order. Banks used to give a loan, without even checking income verification, right? So post 2008 credits, 2008 crisis, we saw a rise of neobanks and so-called shadow banks. These are not really the banks, but they have money. They raise money from pension funds. They'll raise money from endowment funds. They raise money from family offices. These are what we call as a private credit issuers or private credit players. Like many of these players came from a private equity world, right? Which is, if you are a MBA finance or if you're a CFA, if you go to Wharton, go to NYU, go to Harvard Business School, after doing investment banking, I want to get into private equity, right? That's like the top notch, right? I've reached the top if I'm a PE player. So a lot of these private equity players moved into private credit because they saw there's a gap created. Banks can't lend to those companies because those companies are riskier than what the regulators are okay with. But hey, if I can get paid, I'm not a bank, then I can lend to those companies. Because at the end of the day, it's all about risk and what you're getting paid for. Right? But if the regulators will come in, they won't allow you to do certain things. But as an investor, even in your personal life, my personal life, every time we have to think, if we don't take any risk, right, then there is no progress made. For every time you do anything, there is always a risk involved, but we look at a trade-off and say, okay, what's my gain? Right? And then we decide this risk is worth taking because I'm being compensated enough for taking that risk. I invest in the market. Is there a risk in the market? Absolutely. But I think we get compensated for going through that volatility in the market over long term. Otherwise, you can just invest in your CDs and or keep in savings account and earn 1%, like 0.1%. So these private equity players saying, oh, there's enough of a fee to be made. Good, we can charge higher interest rate with these companies that want to raise loans, and we are not regulated. I mean, banks regulators don't look at us, so they started to capture that market. So now big players in this space are Apollo, KKRs of the world, Blue Owl Capital, Ares, and then there are a lot more players. And the investors in these are hedge funds, endowment funds, pension funds, and they've been doing it because they want to diversify their investments, right? Hey, I'll have some in public market, I'll have some in venture capital, I'll have some on the private credit, right? So they want to diversify, and so these are the big, and these are a big players, right? They have billions of dollars under management. And another big reason of why, let's say, pension funds or endowment funds had invested in private credits was it's not as volatile. And that's what the private credit issuers will tell you. You know what? S&P 500, too much volatility, dude. See, 2022, S&P was down 18%. Sure, 2023, it was up 23%, 24%. But you know how volatile this is? If you are running an endowment fund, you can take that risk of volatility with your portfolio because you got salaries to pay. If you are a pension fund, you have a pension liabilities that you need to sponsor, you need to fulfill. Here comes a private credit. We manage it so well that the volatility is not there. Sure, maybe a little less percent you'll make than what in S&P, but much lesser volatility. So that was the game plan. That was the story behind it. Right? And what happened to that story? And how do they know that there's less volatility? It's private. It's not, there's no public rating for it. So let's say if you are a company that has taken loan from me, you took, let's say, $1 million, billion dollar loan. Let's say I'm a rich guy, right? Let me pretend. And I gave you a loan for $1 billion. And you showed me the books, things look good. I gave you the loan. It's a 10-year-old loan. Now I've taken that loan and let's say I'm charging you 10%. Now take that loan and go to pension fund and say, I have this, I securitize this. We're going to get a 10% return. I'll basically take off my fee and all that. You buy this loan from me, you will get 9% return on this one. And your principal is protected because, hey, the value doesn't go up and down. Why? Because they won't tell this, but if you're never going to revalue your assets, then you can mark it wherever you want to. There is no open market for these. These are private stuff. If you have an Apple stock or if you own Google stock, you know the price of the Google share every tick. In private credit, there's nothing unless you go back and revalue the assets. So in 2022, when the public market crashed, and then a lot of these assets on the private market, they were still trading at the same valuation where 2021 because the issuer refused to mark it down. Because they said it will come back up, right? So that's how they basically, I think somewhere at the summary I have the word which is called volatility laundering. Basically, it's a legal way to, money laundering is illegal, but you can launder volatility. It's like I am saying, I won't even get measured up. I won't even step onto the scale. So I didn't gain any weight because I refused to get onto the scale. Right? So that's all. Now, what happened since 2020? Now, why are they looking for retail investors? Because since 2020, after 2022 crisis, the investors in these private credit funds, which are venture capitalists, pension funds, they ran out of capital because IPO market dried up. So they have investments in the VC funds. When VCs take the companies to IPO, they will get the proceeds, they'll return it back to their LPs, which are these limited partners LP, which are these venture capitalists, pension funds, endowment funds. IPOs are not happening. I mean, very recently IPO market opened up. So that market has been down. IPO is not happening much. So those the sources of the private credit say, sorry guys, we ran out of capital. You haven't given me my return. I haven't received my capital back. So I can invest more. So what these issuers have to do, I need to find a new source of capital if I need to continue this game. Where is the source? We already have pension funds. We already have endowment funds. We already went to, these home offices, etc. Oh, there is a trillions of dollars sitting in 401k. Right? Maybe we can get some portion of that. Retail investors. Right? So let's talk to retail investors and tell them how great this world is. And let's use their capital. So now we are over. That's why after 2020, prior to that, nobody wants to think about retail investors. Now suddenly everyone is like, oh, come on, let's help retail investors. Let's give them access to the low volatility that only till now only institutional managers or had access to. So that's the background why they're coming and why you are seeing so much of a news around as a retail investor. Hey, this is good for you. You'll be playing in the same league as the big boys. We are democratizing access to private credit. Now let's look at what the current state is, and then you can decide that is it for you or not. So one lesson that all of us learned with Harvard, what happened with Harvard almost a year ago, or was it earlier this year, is when Donald Trump, I think probably it was earlier this year, had said that we're going to cut funding to Harvard, no federal funding to Harvard. Howard said, gosh, I need to pay salaries. Let me go and look into my portfolio of private credit that I had, and let me sell that. Right? And the issuers had said, this is $100 worth. When Howard went to sell it in the market said, come on, this is crap. I'm not going to pay $100. So, and there no one know at what price they sold, but I think saw Bill Ackman saying probably they had to take a haircut of 20-30%, maybe up to 40% to sell those private credit assets that they had on their balance sheet. And then they had to take loans. So can you imagine? Right? Now similar, I think Yale had the same issue. Now all these players are becoming wiser saying, gosh, you guys killed us. You never marked up the value to what the true value is. So on the books, you are telling me this stuff is worth $100 because that's what you bought it at. But after that, a lot of stuff has changed. Things, the value have gone down. You never mark the value down because it's private. There's no public market. I have to believe what you say. Now, when I'm trying to go and sell it in the public market, I'm figuring out, oh, these are like worth not $100, maybe $70. I'm not giving you more money. Right? So Harvard actually had to raise debt to fill up that gap. Right? And then I realized there was some news around Yale also went through similar issues. And now these private credit players say, gosh, we need to, who else do we get the capital from? So they are coming for retail investors. Right? I'll probably not go through all. So very recently, there was a lot of concerns around these cracks that we are seeing in private credit. That's why Jamie Dimon also came and said that there are never one cockroach in the closet, right? Because we had a big bankruptcy of a company called First Brands. It had rattled Wall Street because now we probably don't know the company, but this is a company that manufactures and distribute a lot of these auto parts, frame filters. I've used frame filters, windshield wipers, spark plugs, and a lot of stuff, right? So, and it is like almost 100% owned by the single owner. So if as that as a business, I go to a bank and say, give me loan, bank will say, come on, I can't give you because I have a huge risk. You are the only owner, right? But then you can go turn around and go to this private credit issue saying, you know what, here's my books, here's my business, I need loan. And that's what they gave a lot of these companies, private credit companies, or the arms of the banks gave the loans to them. And that declared bankruptcy. And the Wall Street was shocked. What the heck? It is almost a $12 billion bankruptcy. And now the court is, they're still going through that. The overall debt, they filed for bankruptcy, they figured out the overall debt is $12 billion. Right? Now, leverage cut both ways. They wouldn't have seen it until this tariff wouldn't, if tariff wouldn't have happened, it probably would have survived. But once tariff happened, it margin, so the price, so margin started to decrease. They couldn't pay up their interest, and then they went through the proceedings, and now the accounting is figuring out that, oh my gosh, they had done they did double dipping. They basically bought loans, say at a one invoice, and they'll take it to the bank and say, hey, can you pay me against this invoice? This is a pretty common practice called factoring, and the bank will give you the loan because bank know the customer will pay the invoice and then bank will get the money. But what they did, and this is what allegedly, they say they took the same invoice to the more than one banks, not the banks, but these private credit issuers. They did a double dipping on it, stuff like that. Now then they say, oh, some of the assets are missing. We can't find the asset that they told they have. And now if you're looking at this, I mean, the questions that are being asked are, where are those smart private credit guys? What were they doing prior to issuing the credit to them? Why were they not looked at the books? Why? And then there were concerns around Jeffries was an investment banker, which will basically take their credit and sell it to all the other Wall Street firms. They also had an arm, their own subsidiary, which was giving a private credit to them. So there was like a whole lot of a conflict around why Jeffries didn't do this, were there some corporate malfeasance? My biggest question is, do you guys even look at the books properly, or everyone is now happy with the amount of a fee that they're making, either through as an investment banking fee or as a higher interest rate that you're taking and not focusing on the risk? So there is first brand went down. Another company, Tricolor, went down, right? Because again, there are the delinquencies in the auto sector. Auto loans have been increasing. So, as long as the things are happy, you'd never figure out. But once the market start to tighten up, you'll see these things falling apart. And now we're realizing, gosh, these all were sponsored by these private credit firms. So UBS, FT reported that UBS had exposure to first brands, right? Jeffries had undisclosed fee, right? And then I think this week I saw some BlackRock and BNP Paribas. They had exposure to some another private credit fraud. It was orchestrated by some telecom guy in Mauritius. I mean, these are big companies. And if they can't figure out, or maybe they choose to ignore because the fees are so fat and can't do a good job, as a retail investor, what capability do you have to assess any sort of a private credit? And no wonder if you look at these companies, KKRs and the Apollos of the world, KKR, where's year to date? The stocks have been beaten down. I don't know, Blue Owl Capital. Down 40%. Apollo Global Management, right? I don't know. Year to date is fine. 20%. Market is like, what the heck this is? This is like give you similar vibes as housing crisis. I don't know. I'm not saying whether like, maybe the next, people say, oh, there's a bubble going in the stock market. You need an event to burst the bubble. I don't know if that event or the stimulus is going to come from AI or whether it's going to come from private credit. Suddenly we realize that the private credit has spread itself into so many other companies which have become systemically important. So banks can't do it, but then they create a subsidiaries who will do it. We never know. Right. So now we're seeing that, come on, BlackRock is involved in it, BNP Paribas, which is a bank, is involved in it, probably through some subsidiary. Right. So anyway, so here's a quick summary on let me make sure. I've been talking for such a long time without looking at the chat. So I'll go through the chat messages later. Right. So first of all, the P or private credit flywheel was broken because this whole exit didn't happen, right? Everything would have been fine if we didn't have 2022. But since 2022, you didn't get exit, you couldn't return the capital back to your limited partners. They are not able to invest more in that. And then we figured out that, Harvard, Yale, etc., they can't even, when they try to sell their private credit assets in the market, they're like, you're getting paid only 60 cents on a dollar or 70 cents on a dollar. They figured out, okay, the game is over. Not over, but hey, we've been exposed. So first is the underperformance of these companies itself we saw. Then there are structural vulnerabilities exposed by high rates. Right? P firms, they generally are levered up. Right? And if the interest rates goes higher, your expenses goes higher. Right? And that's what we're seeing in a lot of these companies, that now if you have to refinance your loans, it's giving tough time to them. Illusion of stability, right? Stale pricing. It's a low volatility, smooth returns. They say, invest in this, you'll have a smooth returns, because the private assets, they are appraised, not market. They are appraised only periodically, and they're not marked to market on daily basis. This is what the volatility laundering is. If I'm telling you, I'm going to look at the assets only at the start of the year, or maybe after 2 years later, then this whole April Liberation Day, etc., is immaterial. But if you are one of investor who need money on that Liberation Day, you try to sell it, you are like down 60%. But I'm not going to mark too much. I'm going to only do periodically. Right. So that is where it is a manufactured stability. This is what it's called volatility laundering. There is volatility, but if you close your eyes and say, I'm not even looking at it, that's what this stuff is. And then they have a misleading metrics like IRR, because you can manipulate IRR by changing the timing of your cash flows. And that's why there's a search for new capital. You're getting a retail investors now to fund these loans, etc. And now some firms won't even take a loss. Let's say if I were to sell these private credit assets to someone in the public market, I'll have to take, let's say, 50% loss. So some of these guys are doing is, now you see, if you read through it, you'll see something called continuation funds. So I have one fund which I got private assets. And now I know that if I go and sell these to outside companies, I'm going to get 60 cents on a dollar. I'll create another fund and then I'll move the assets to the other fund and I'll call this new fund as this is a continuation fund and I'll move it at par value. I mean, this is like you talking about accounting irregularities. I mean, I don't even know how to classify this, but this is like, gosh. So guys, before you get into this whole private credit, I hope you do your due diligence. You may have a capability to do it. I have absolutely zero capability to figure out how to even do due diligence. And now I don't think I can even believe the Carlyles and the KKRs and the Polos of the world to do it on my behalf. I mean, they are losing money themselves. And now they are engaging into this continuation fund, which basically has the same crap asset, which they move from one fund to another and didn't reevaluate because there's no exit. And they're just trying to figure out how to float above water. And one thing that can help them float above water is the new source of capital. And that's why they're coming for your 401ks. So I thought this has been long pending discussion on this. Less discussion, I guess it has been mostly monologue. I'll go through the questions now, but I was like so indignant saying, don't tell me that you're doing it for retail investors. Don't tell me that suddenly you woke up and say, oh, we want to democratize access for retail investors. No way. It is because you ran out of options. You need money and you're looking for, the next scapegoat who I can skin it. And you're looking at the retail investors now. You're looking for the suckers, right? Who the suckers are. And let me get to them. All right, that brings to the end of the session. I'll open it for breakout room. Let me just go through the comments. And then I'll have to get out of the room. I told hotel that I have a late checkout, but I'll be on phone. So let me go through some comments. Tom says, I sold and traded corporate municipal bonds. Well, Tom, so what do you have to say? I mean, I'm a retail investor. I may be completely wrong in thinking about or saying what I've said.
You're absolutely right. Run.
Right? Because looks like you've been in these trenches. I've never. I spent most of my life in the tech industry, so not in financials.
I make reference in my note here on my text to municipal bond insurers. There used to be companies called AMBAC, FIDGIC, and others that would insure municipal bonds. They were very successful companies, staying in their lane. And then when the whole mortgage thing, got bigger and the securitization of subprime, they decided that they would insure mortgages as well. All those companies are bankrupt now.
Yeah.
And many municipal bond insurers, municipal bonds were thought to be a safe and secure investment, especially if you had insurance on it, ended up losing a majority of their investment, if not all, because the insurance they looked to in their municipal bond investment was no longer there.
Yeah.
So at the end of the day, retail's a sucker, and they're just trying to maybe repackage these things in the future and unload it on innocent retail investors.
Yeah, and it is coming like Apollo and State Street. They already signed up, or they collaborated to create an ETF, and I don't know how they're going to mark up the value of ETF on daily basis, and who's going to backstop it? And I think what I read, and it's maybe almost a few months ago, 6, 7 months ago on Wall Street, saying Apollo is going to basically be the backstop. Let's say if you want to ETF, you want to sell your ETF, you need to get cash. Now, these are private businesses. If I'm selling ETF, you're not going to sell a laundromat. So they say Apollo is going to backstop it. Then you got a counterparty risk and all that. I'm like, what the heck is happening here?
So this mark-to-market issue is a very important one, as opposed to carrying things at purchase value or their original price, 100 on the balance sheet. That is effectively what caused the collapse in the mortgage market and the default of Bear Stearns. I call it a default. They sold to JP Morgan, actually. But of many other primary Wall Street dealers, which no one would thought would ever go away. Merrill Lynch went away. They went to Bank of America. And I mean, that was almost the end of the US financial system back then. But a lot of it was predicated on the mark-to-market pricing, which deteriorated the capital at the banks of these declining subprime mortgages, which they had on their balance sheets. It's only when the Treasury Secretary at the time, Paulson, declared that banks no longer had to market from current prices their mortgage holdings and stop the short selling of financial institutions stocks, that in, I believe it was March of 2009, the financial crisis, S&P hit a bottom. I think it was like a SPX 666, interestingly enough.
Wow.
So I'm not saying this is at that same scale, but it's significant nonetheless and worth watching. And you're doing a service, by the way, to everybody on here by cautioning them about it, in my opinion.
Yeah, hopefully, I mean, I love to talk about investing and hopefully bring up whatever I see in the market. So yeah, if someone can benefit from it, that'll be my reward. So even I think similar to this, we saw in 2023, some of the banks went bankrupt because they had to sell some of the bonds which are all underwater, and suddenly if those get revalued, the balance sheet was upside down. Even I think today, right now, also there are many banks in our banking system that still hold treasury bonds which are underwater, but those are being classified as HTM, hold to maturity, means I'm not gonna market at the current market value because I'm gonna wait and hold it through maturity, and I'm gonna get interest. Treasury government, US government will continue to pay interest. So this is which is true. You mean as long as you can hold it through maturity, you'll be fine. But we did see some of the banks that they had to sell, and we had that mini banking crisis earlier. So yeah,
that was driven by Silicon Valley Bank, right?
yeah,
Created all that. But the problem is, it's still a problem though, because those banks are only earning the old rate on treasury bonds of 50 basis points to maybe 1% at best in a world where 10 years at 4%. So yeah, they now classify it as held to maturity, but it's not helping their cash flows or their business in any way.
That is true. And I think this was like we talked about it in the meeting, that this is the irony is that the banks actually went under by holding the safest security in the world on their balance sheet, which is the treasury bonds, which is considered to be the as safe as you can get. And they went under because they had too much of it. Anyway, so that's we are almost close to 12:30. If there are any questions on what we talked about, I'm open for that. Otherwise, I'll open up the breakout rooms and I see it, and then we can get into option trading or deeper discussions around day trading, swing trading, whichever room you want to join. But before that, let me address one question I see from Vinay. There is a special vehicle financing being done by Facebook, etc. with Blue Owl. Would that also be private credit? So Blue Owl is a big private credit issuer. Now you actually brought in another topic which is around SPVs. And recently, with these Oracles and the Metas of the world, we are seeing a lot of companies going through SPV route, which inherently isn't illegal. But the companies want to do this SPV so that the bigger fixed assets don't come onto the Meta's balance sheet, right? I'm a Meta, I'm a capital light business. That's where you enjoy so much of a multiple. I'm a Google, I'm a capital light business, right? These tech companies. Now, if you are investing in $100 billion and owning a data center, which is a fixed servers and the buildings, you're no longer capital light. Then why should I give you that multiple? So for that reason, It is not uncommon. It is not surprising that companies like Meta, etc., will go through a SPV route, package the assets, or do everything under that special purpose vehicle so that the assets don't come onto the Meta balance sheet. Now, the question is, I think in that SPV, Meta gave what, 3 billion, another 30 billion is coming from Blue Owl. The only concern would be, what if Blue Owl is not able to, provide all the capital, and then we don't get the data centers built out? Yeah, that will be concern. But Meta has cash flow available, but they chose not to use the cash flow, full cash flow, and rather go through the debt route. Number one, they can afford the debt, right? But if, let's say, Blue Owl goes under and Meta says, you know what, I'm gonna basically sponsor it on my own, then yeah, there will be impact. But this is at least better than some of the other private credit deals, because here we're talking about the companies like Metas and the Googles, which are legitimately big businesses, public businesses. You can view their balance sheet, and it's not dependent on some crazy one founder who own 100%. So I'm less concerned about that deal. If someone is willing to sell me, let's say, repackage this Meta deal and sell it, yeah, maybe I'll be willing to own some of it, but I'm not gonna own, the other private credit stuff. So that will be my thought. And we saw this, anytime there will be some market will get little concerned about it, like they had it for Oracle, the cost, the CDS against that Oracle, the deal or whatever the special purpose vehicle, how they are funding, that went higher. Okay. All right. Yeah, Vinay, they're doing off balance sheet. Cool. So let me open.
Vivek, I had a quick suggestion. I was just wondering, would there be any interest in another breakout room around like multi-baggers?
Multi?
Baggers?
I mean, I don't know. I mean, I'm open with whoever wants, but I generally see. So I can rename the fundamental investor to multi-baggers. Let
Well,
me
I think
do, because
slightly
some of the rooms are not even, nobody goes in there.
populated.
Nobody is a fundamental investor.
Yeah. Okay, fine.
Okay, let me do multi-baggers. Maybe that's more attractive. Okay, so I got a TA, day trader, swing trader, option futures, noob investor, alternatives, crypto, private credit, options, and futures. I'll open all the rooms. You can go and join any room that you want to. I have time till 1 p.m. After that, I have to vacate the room. I can be in the lobby. Is there any questions? Otherwise, I'll jump into some other room. Anything else you want to talk about?